Good morning, and thank you for joining us for Rivero Gordimer & Company's annual audit and assurance update. My name is Stephanie Smith, and I'm a senior manager here at Rivero Gordimer & Company. I have over 20 years of experience working with nonprofit organizations in the Tampa Bay area. Over the years, I have worked with organizations of all sizes, including those in the health and human services and affordable housing sectors. I recently joined the firm in December, and I'm happy to be here.
My name is Brooke Bauerle Dawson. I'm also a senior manager with Rivero Gordimer & Company. I've spent my 9 years with the firm working primarily in the nonprofit sector for a variety of organizations, including local and national foundations, educational institutions, and social service organizations. We're happy to have you here this morning. We are the largest Tampa-based accounting firm, as well as the exclusive member of the Nonprofit CPAs Alliance in the Tampa Bay region. We are currently celebrating our 40th anniversary. Our team is involved in 60-plus charities and touts 500 years of combined accounting experience. Our firm was also named Small Business of the Year in 2018 and received the One Tampa Bay Award from the Tampa Bay Business Journal in 2022, recognizing our service in the Tampa Bay community. Thank you again for joining us this morning, and thank you to our nonprofit committee for all the hard work they do throughout the year, including organizing this webinar. Today I will be starting with an accounting standards update and then turning it over to Stephanie to give a nonprofit industry update, as well as wrap us up with an audit standards and Yellow Book update. If you have any questions throughout our presentation this morning, we will be available via the chat feature or via email at events@rgcocpa.com. If you are seeking CPE for this morning as well, you can also email events@rgcocpa.com. The first upcoming standard we will be touching on today is LEASES. We can finally begin to put this issue that has been discussed and debated for many years behind us. ASU 2020-05 was issued in June 2020 as a response to the COVID-19 pandemic by the Financial Accounting Standards Board. This essentially deferred implementation of both the LEASE standard. For our December clients, you've already seen the effects of this standard when preparing your 2022 year-end statements, but you may continue to get questions from board members, financial institutions, and even donors as to why they see these new assets and liabilities on your balance sheet. So what is a lease? A lease is a contract that conveys the right to control the use of identified property, plant, or equipment, the asset, for a period of time in exchange for consideration or rent. Control over the identified asset means that the customer has both the right to obtain substantially all the economic benefits of the right of use asset and the right to direct the use of the asset. Note that the scope of this ASU does not apply to intangible assets, inventory, assets under construction, and also excludes donated assets, which is known as in-kind rent. This next slide depicts the lease model. The contract conveys the right of use of the asset for a period of time in exchange for consideration or your lease payment. The right of use asset is the asset explicitly identified or specified in the actual lease. The lessor has the right to control the asset during the lease term and obtain the economic benefit from the asset, whether that's using a building for your office space or producing goods with leased equipment. When evaluating an operating versus finance lease, previously a capital lease, there are several items to consider. The first few questions can be answered fairly easily based on the terms of your lease agreement. First, does the lease transfer ownership at the end of the lease? Second, does the lease grant the lessee an option to purchase the asset, often known as a bargain purchase option, and is the lessee reasonably certain that they will exercise this option? This is something we see a lot in a copier lease. These next ones require a little bit more analysis on your end. Is the lease term a major part of the remaining economic life of the underlying asset? This question would be pretty easy for things like a land lease. Land will be around indefinitely. If you're leasing land for 10 years, that's nowhere near a major part of the economic life of the asset. Most buildings would be the same. However, if you are leasing, say, equipment on a 5 to 10-year lease, you should document and analyze whether or not this is the substantial major part of the asset's life. Next, do the present value of the lease payments equal or exceed the asset's fair value? Previously, if this was an operating lease, you do not have to make this calculation. However, now you'll be making this calculation for either a finance or operating lease, so you'll have this number readily available. This is something that you could do internally, or your auditor or third-party accountant could help you with. This is where you would want to estimate the value of the leased asset. And this could be done to see by reviewing appraisals or pricing out similar equipment. So you would see if the present value is exceeding or equaling this appraisal. Lastly, if the asset that you're leasing is so specialized in nature that it has no alternative use, so once you're finished using it, there's really no use for another lessor, then this would be considered a financing lease. If none of the above conditions are met, it will be an operating lease. So what is the bottom line effect that your donors, your grantors, your board will see on your financial statements? This next slide breaks it out for both finance and operating leases. For both types, the lessee will reflect both an asset and a liability. They will have some differences on the income statement and cash flows. With the income statement and cash flows for financing lease, this will reflect a lease expense and an amortization expense. Whereas an operating lease will simply reflect the lease payment expense and the actual cash paid. So the financing lease is going to have a little bit more of a complicated journal entry when it comes to this side. For both the finance and operating lease, there will also be required footnote disclosures, which include both qualitative and quantitative information on the terms of the lease. Please note that any changes to the lessor side, so the actual owner of the asset, is fairly minor. This is why you don't see a lot of examples coming out in any of the CPEs or any of the ASU guidance that has been provided. This next slide breaks out how you measure this initial asset and liability. So there's some few steps you have to take when looking at this. First, it's important to understand your lease period. For example, if you sign a 5-year lease with a 5-year renewal option that you plan to exercise, you should consider both of those terms, so 10 years, when addressing the present value of the lease payments. You would also consider any initial direct costs incurred to obtain the lease, as well as any lease incentives like free rent. Initial direct costs would include commissions paid, as well as payments to an existing tenant to terminate the lease. This would not include general overhead or legal fees that were used to negotiate the lease. Again, you want to consider things like free or reduced rent when you calculate this. Any variable costs, including sharing of utilities or of a variable CAM payment, would be excluded as well because you cannot reasonably estimate these numbers. Lastly, you're going to want to look at the discount rate. This rate would generally be implicit in the lease. However, unless it's a financing lease, this is generally not going to be in your lease. So next you would look at your incremental borrowing rate. So what rate are you having to pay a bank on a line of credit or on some sort of lease? If neither are available, you will use the risk-free rate. Also note that if your lease is 12 months or less, this is considered a short-term lease, and you're permitted to have an accounting policy not to recognize these lease asset or liabilities. This information can be used going forward as you continue to renew leases or enter into new leases and want to keep those off the balance sheet. This can also be said for related party leases, which generally have a termination clause in them and may not be fully enforceable. These would not be put on your balance sheet as well. Next, we will briefly touch on gifts in kind. So this is ASU 2020-07, non-for-profit reporting of gifts in kind. This is effective for annual periods after June 15th, 2021, and requires retrospective application. Most organizations should have adopted this by now, but again, you could still be receiving questions on the subject or even refining the way you record gifts or continuing to improve your footnote disclosures on the matter. So what prompted the change? An increase in transparency about gifts in kind. Many nonprofit entities rely on gifts in kind to fulfill their mission and run their programs. This is an important financial information to financial statement users and can affect some key metrics. Contributed non-financial assets include fixed assets, use of fixed assets, also known as in-kind rent, materials and supplies such as food donations, clothing donations, as well as in-kind services, which could include free legal or accounting services. This next slide just reiterates what are considered contributed non-financial assets under the new ASU. You have tangible personal property, including food, clothing, household goods. Contributed services. So this is the one you have to pay a lot of attention to because there are certain criteria that need to be met for these services to be recorded. So these would be services that create or enhance non-financial assets that are provided by individuals possessing specialized skills, like an accountant, a lawyer, a doctor, or a teacher. These do not include volunteers that are handing out food or helping in a thrift store. Real estate, so discounted or free use of land, buildings, or equipment. Donated advertising is also considered specialized and considered a donation of an asset. There are some guidelines here as well, including that the nonprofit must approve the ad, have use of its logo, and have significant influence over the actual content of the ad, whether that be in a newspaper, on a television, or on a billboard. Lastly, commodity grants. So these would include direct supplies of good by a donor, like donated foods or drugs that are going directly to the participants of the nonprofit. ASU 2020-07 will now require nonprofits to separate out all gifts in kind on the statement activities, separated from cash contributions. So there will be an actual line on your income statement that reads gifts in kind or contributed non-financial assets. Nonprofits will also have to disclose a disaggregation of the amount by category. So showing the reader whether this is goods, services, or rent or use of a fixed asset. Then for each category, provide information on how the assets were used during the fiscal period or if they were monetized and or sold. The nonprofit will be required to disclose their policy on monetizing rather than using the contributed assets. So if you're selling these in a thrift store or if you're gifted a car and you're selling that. Any donor restrictions on the contributed assets will also need to be disclosed, as well as the valuation techniques. So how does the nonprofit assign a value to the donated goods? Do they receive a letter from the donor? Do they look at market prices of similar items? Is it by the pound? Is it by the item? This all needs to be included in your financial statements. Here is a good example of a disclosure that meets the new requirements. As you see, it notes how the assets are valued, the amounts received, any restrictions, as well as where the use is. So really, where is this expense if you're not keeping it on your books and capitalizing it? Where is it falling in your statement of functional expense? So now that we've touched on those two that should be implemented this year, if not already, what is coming next? As we move forward and finally leave the LEASE discussion behind us, we will discuss what accounting standard updates are on the horizon. This next slide lists some of the new accounting standards that should be implemented over the next year or two. This includes ASU 2013-02 investments, which focuses on the equity method and joint ventures effective for public companies in 2024 and all other entities in 2025. This primarily relates to amortization of tax equity investments and shouldn't have much of an effect on your nonprofit entity. ASU 2022-05 Financial Services. This affects public companies in 2023, all others starting in 2025, relates only to insurance companies and long-duration contracts. 2022-04 Liabilities Supplier Finance Program, effective in 2023. Again, this applies only to entities that offer payables financing or payables arrangements. 2022-03 Fair Value Measurements. This clarifies the fair value measurements of equity securities that are subject to contractual sale restrictions. This is to be adopted in 2024 for public companies and 2025 for private. ASU 2022-02, financial instruments, credit losses. This was previously issued as ASU 2016-13 and is effective in 2023. This affects multiple financial instruments that your organization may have, including financing receivables, programmatic investments, trade receivables, contract assets, and loan commitments. The new guidance essentially changes the recognition period of any potential loss for when the probable loss has occurred to when the losses have been expected. Stephanie will touch further on this and how this may directly affect your organization and what you can do to better prepare in the latter half of our presentation. Lastly, ASU 2022-01 deals with derivatives and hedging. This implements the last of layer method and is effective for public companies in 2023 and all others in 2024. So what is coming after we implement all that long list of ASUs that I just rattled off? So what is FASB looking at as the next hot button issues? It's really important for both companies, including nonprofit companies, and auditors to understand what issues they're looking at. Items currently on their agenda include crypto assets and software costs, as well as credit programs and tax disclosures. They are also looking into clarifying how business entities that received government grants are recording these. This is partially in response to COVID relief programs from the government, which have taken place. Stephanie will touch a little bit more on some responses to crypto assets that your organization can take later in the presentation. And I will now turn it over to Stephanie for a not-for-profit industry update. Stephanie?
Before we dive into the new auditing standards and changes to the governmental scene, let's take a look at some statistics related to the overall nonprofit industry as it stands currently. An article published by Zippia.com highlighted the following statistics that emphasize the importance of the nonprofit sector. The nonprofit sector represents the third largest workforce in the U.S., falling behind only retail and manufacturing. This equates to employing 10% of the workforce in the U.S. There are an estimated 1.5 million nonprofits in the U.S. and 10 million nonprofits worldwide. Approximately 80% of all nonprofit revenue comes from government grants. This last statistic I found pretty impressive. In the fourth quarter alone of 2022, U.S. nonprofits contributed $1.5 trillion to the economy. This statistic came from independentsector.org, which publishes a quarterly report on the health of the U.S. nonprofit sector. In that same article, Zippia.com also cited the following giving statistics. Pre-pandemic, 65% of Americans donated to a charity. During the pandemic, this decreased by about 10%. However, over that same time frame, the average individual contribution increased as reported by DonorBox.com. In 2019, the average gift amount was $617 compared to an average gift amount of $813 in 2021, an increase of approximately 24%. What this tells us is that through the pandemic, the majority of those that gave pre-pandemic continued to give through the pandemic and in greater amounts. Please also keep in mind that these are averages. I don't want to downplay the toll that the pandemic took on organizations as a whole. Every organization is unique and all experienced unprecedented challenges over the last 3 years and continue to face new challenges in the aftermath. Those are some national trends, both pre and post shutdown. So let's see how Florida measures up. According to Giving in Florida, 7 out of 10 households in 2021 made a charitable donation, and of those, 74% gave to organizations based in Florida. In addition, the average household donation was just over $1,000. Compared to the national averages we just discussed, Florida is a pretty generous state. Next, I would like to go through some things that are still out there and others that may come up in the future. Although the door has closed on available PPP funding, employee retention credits are still an available source of relief. For all payroll quarters in 2020, you have until April 15th, 2024 to amend your payroll tax returns and claim your credits. For all payroll quarters in 2021, you have until April 15th, 2025. If you haven't done the calculations or are convinced that you don't qualify, I would encourage you to at least run through the numbers with your accountant. When eligible for several quarters, these credits can add up pretty quickly. The next hot topic is contributions of crypto. Ever since the crypto crash at the end of the last year, it seems like there's always something in the news about it. In response to requests for advice related to contributions of crypto, a memo was issued by the Office of Chief Counsel for the IRS. The memo is quick to say that it shouldn't be used or cited as precedent. The two issues identified in the memo were: one, would the donor be required to obtain a qualified appraisal in order to claim a charitable contribution of $5,000 or more? And two, if an appraisal is required, does the reasonable cause exception apply? Meaning, would the taxpayer be able to value the cryptocurrency based on the value reported on the related exchange on which it's traded? On the first point, the IRS concluded that yes, a qualified appraisal would be required because even though digital assets don't exist in a physical form, they would be treated as property under the IRS rules. As far as being able to use the reasonable cause exception, the IRS concluded that it does not apply. Qualified appraisals are not required for certain readily valued types of property, such as cash, publicly traded securities, and inventory. Based on the analysis provided in the memo, cryptocurrency, even though it is regularly traded, does not meet the definition of a publicly traded security. So what do you do if you receive a gift of cryptocurrency? Many organizations have a gift policy that provides for the sale of donated securities at the time that they are received. Given the historical volatility of cryptocurrency, I would expect that organizations would opt to treat donations of cryptocurrency in the same manner. On a side note, in doing some research on cryptocurrency, I discovered a type of cryptocurrency called meme coins, which is crypto that sometimes depicts a funny picture or meme and has an online following. So for the dog lovers, according to Wikipedia, Dogecoin was considered the first meme coin and the first dog coin. The meme here for Dogecoin is from Investopedia. Next, let's take a look at CECL. What is CECL? CECL stands for Current Expected Credit Loss and refers to an accounting standard update that was passed in 2016. It is codified under Topic 326 as Measurement of Credit Losses on Financial Statements. Some of its key provisions include the following. It removes the incurred loss model for credit losses, which focused on estimating credit losses based solely on historical information and now requires the use of an expected loss model. The expected loss model takes into consideration not only historical losses, but also current and expected future conditions. CECL does not require any specific methodology to be used, but does identify several allowable methods within the standard. CECL applies to credit losses resulting from a variety of transactions. The two types that I believe may impact nonprofit organizations are programmatic loans and receivables resulting from revenues recognized under ASC 606. Our old friend, the revenue recognition standard. When CECL was first released, I think most of us overlooked it and passed it off as only impacting financial institutions. After further consideration, certain nonprofit organizations may also be impacted by this standard when it becomes effective later this year. So what should you do? First, take a look at your streams of revenue to determine if CECL even applies. Keep in mind that CECL doesn't apply to contributions or pledges receivable and grants receivable if you use the contribution model for revenue recognition. If that covers the majority of your revenue sources, then you're probably off the hook. If you have material receivables that are the result of program fees, such as patient fees, or operate loan programs, the standard may apply to your organization. Notice that I said material. As with any standard, materiality comes into play. Also, documentation is key. You may already be using a methodology defined in CECL to determine your allowance. You may also need to document you may only need to document your methodology calculations, judgments, and estimates. And of course, you'd want to discuss any implementation concerns with stakeholders such as your board, finance, or audit committee, and your auditors. We're now going to switch gears a little bit to talk about some of the recent auditing standards that will go into effect later this year. Just when us auditors thought we were going to get a break, we have a whole new set of auditing standards that will go into effect later this year. Here I've listed the SASs 142 through 147 and their implementation dates. On the next few slides, I have broken them into two groups. Those that I expect to have almost no impact on your organization as an auditee, and those that may have some impact on you as an auditee. So for 4 out of 6 of these standards, I do not expect audit clients to feel a direct impact. SAS 142 audit evidence focuses on evaluating the results of our audit procedures. The previous related standard was focused on the design and performance of procedures. This new standard takes a stand-back approach to say, is what we did sufficient to support our opinion? The standard also recognizes how the nature of audit evidence and the way we obtain audit evidence has changed. For example, previous to the pandemic, we may have flown to a client in California to perform inventory observation procedures. The pandemic forced us to find alternative means, and this year, that same inventory observation was completed virtually over Zoom and using a camera in real time. The next SAS 144, use of specialists and using of pricing information. This standard provides additional guidance on both the auditor's and management's use of specialists. Next, SAS 146, quality management for an engagement conducted in accordance with generally accepted auditing standards. SAS 146 is the only standard on the list that doesn't go into effect until 2025 and coincides with changes coming down the pipeline for audit firms related to a shift from quality control to quality management standards. Finally, SAS 147, inquiries of the predecessor auditor regarding fraud and noncompliance with laws and regulations. This standard expands the required inquiries made of predecessor auditors to include identified or suspected fraud and no CLAR, which means noncompliance with laws and regulations. We like our acronyms. And this one surprised me. The standard now clarifies that inquiries of the predecessor auditor and the results of those inquiries should be documented. However, I think most of us have been doing this already. The following standards, you may see some impact in the form of additional documentation requests and inquiries. SAS 143 requires auditors to specifically assess the risk of accounting estimates and to test and evaluate the reasonableness of accounting estimates and their related disclosures. I think the most common impact here may be on the allowance for doubtful accounts, depending on the materiality of it at your organization. SAS 145 revised requirements to evaluate the extent to which IT controls were used and whether or not they've been implemented. It doesn't fundamentally change the risk concepts underlying the assessment of risk, but does make some clarifications. It also now includes the concept that the risk of material misstatement equals inherent risk when you do not plan to test the operating effectiveness of controls. On these last few slides related to current and upcoming single audit and Yellow Book issues, this will round out our presentation for today. With regards to Yellow Book, the last major revision was in 2018. In January of this year, an exposure draft was issued related to proposed revisions that would update and replace sections related to quality control, peer review, and add additional guidance related to the standards for financial audits. Key proposed changes also include those that provide flexibility for audit firms to maintain one set of quality management standards for firms that may be subject to multiple sets of standards. It also emphasizes the responsibility of leadership for quality management, which we've already previously discussed as part of SAS 146. The update also takes a one-size-doesn't-fit-all approach and promotes scalability for firms based on the size and complexity of the firm and its engagements. Even though the compliance supplement is considered an auditor's document, I always encourage organizations to sneak a peek behind the curtain to see what we use as guidance to test their federal programs. Annually, the Office of Management and Budget releases an updated version of the compliance supplement. The 2023 compliance supplement was just released at the end of May. Part 8, Appendix 5, identifies any changes from the 2022 to the 2023 version. And also, left over from the pandemic, certain pandemic-specific programs remain designated as high risk, which may affect what your auditor selects for testing. It's hard to believe, but it's been almost 10 years since the complete overhaul of the federal cost principles and grant award guidance. Uniform guidance, also known as the Super Circular, also known as the Omnicircular, was issued in December 2013. Revisions were made in 2021 that fixed inconsistent citations and references and clarified specific language. In February 2023, the OMB issued a request for information that has since expired. That request for information essentially requested feedback on basically what was working in the principles and what might not be working. According to the federalregister.gov, the OMB anticipates publishing a final update in December 2023. Our committee is also working hard on our 2023 Nonprofit Appreciation Day, which will take place in person at Higgins Hall on November 8th. We hope you are able to join us. Remember to email us at events@rgcocpa.com with any questions you may have and for CPE credit. A PDF version of the presentation will be available through our website. We hope this has been helpful. Thank you and enjoy the rest of your week.